Welcome back. The global setup this morning is looking much better than what it looked last evening, despite the fact that the dollar still remains quite strong, but equity is at least showing some resilience from the lower levels. We have Rajesh Bhatia joining us. He's the Managing Director and Chief Investment Officer at ITI Long-Short Equity Fund. Rajesh's fund actually has outperformed the market. I mean, if you look at the data in June, for example, when the Nifty was down 9%, April to June, when the Nifty was down 9%, the fund was flat, and over a 1 year period, it's outperformed the Nifty by a good 9% or so. Rajesh, good morning. Thanks a lot for joining us. Good to have you on the show. I guess this is your kind of market, right? Long short. So you tell us now, how are you approaching this market? Because this is such a bipolar market. You have IT on the one side, which is just going down. There's FMCG, which is going up and up. Your thoughts on how to approach this market?
Yeah, thanks, Anuj. So basically, this is a macro-driven, narrative-driven equity market, right? And I think the more recent mind of the market has been focused on declining inflation. Although I think that's a wrong narrative for the market to pick up to get bullish, because first, the inflation is really not coming down in an aggressive manner in geographies that matter, which is particularly the United States or Europe. Second, I think the mind of the market is focused really on not peak inflation, but really when does the Fed start to ease, or when can we sense that the Fed is done with its rate hikes or liquidity tightening? And I think that is some time away, because if you look at it, the inflation number in the US is 9.1. Their target inflation is about 2%. That's a big gap. You don't need to be an economist to know that the Fed can't leave the pedal so quickly, which means that if they tighten enough and for a prolonged period of time, then chances are that you will have a larger slowdown, and that will be over a period of time. Now, US is a mother market, 25% of world's GDP, which means that the slowdown in the global economy also is likely to be prolonged. And that is, I think, which is what is more relevant at this moment for equity investors to consider. You also already know that Europe is in a very bad shape, and China is struggling to get its feet back on the ground. So I think the key narrative really that the market should focus on is that there could be a prolonged period of slowdown in the global economy. What does that mean for India? If global growth is going to slow down, it will hurt our growth as well. Read EPS cuts. If tightening is going to be a little prolonged and interest rates and liquidity are going to be sucked away for the moment, read lower Ps. I don't think that narrative is at this moment bullish for the markets.
Which then, Rajesh, hi, good morning. Good to see you on the show. Which brings us to the question, right? But how much of all of this is in the price, which is always a complicated question with no easy answers. But what is your best sense of this?
Prashant, basically, yes, I think valuations have certainly come off to what would be certain long-term averages. But like I pointed out, I think, there is a certain possibility of earnings cuts, as you move forward. I'd like to bring one more point to this table. I think it is underestimated that India also came off a bubble in September or of October of last year. Everybody is clear that yes, US was in a bubble with the NASDAQ and etc. But I think it is underappreciated that India was also in a bubble. We exhibited late stage behavior. If you look at it, what is late stage behavior? IPOs getting subscribed at crazy valuations, retail enthusiasm being, way crazy, concept stocks getting high Ps, futures and options positions being extremely large. Now, if you look at the history of markets, whenever bubbles have burst, whether it's Harshad Mehta, NASDAQ, 2008, valuations don't come to mean and settle there. They go below average. I think that's a context that you should keep in mind when you're looking at markets as we speak today.
Hi, Rajesh. Morning. As Anuj mentioned, when the market underperforms, you have made money. I think even in the COVID period, you relatively outperformed for your fund. So that's good on you. But you run a long-short fund. How has that changed, the longs and short positioning, maybe in the last couple of months? If you could give us a rough number or give us some kind of indication as well.
So Nigel, basically as a long-short fund, when you sense trouble, the first thing that you do is reduce your positions, because then it removes the possibilities of making mistakes, right, with your longs or your shorts. So you reduce your what is called gross positions, that you have in the market. Fortunately, Nigel, as you would be observing in the market, so many narratives of sectors over the last 2 months have changed to the negative, right? An aggressive player comes into the cement business, the narrative of cement changes. An aggressive player starts bidding for 5G, the narrative for hopefully it's not changing, but telecom gets, at least scuttled. Export duty on commodities, steel gets scuttled. Export duty or taxes on oil. So, you get the point. There are so many narratives that have changed to the negative, which means, the short book has been fairly well fed, as we speak.
So, Rajesh, what's your portfolio looking like now in terms of the top sectoral bets and top stock bets, if you can? How's it looking now?
So on a sectoral basis, we are long autos, consumer, and domestic pharma. Of course, the short side is fairly diversified, but it does include certain financials which are trading at 3 or 4 times price to book. Even now, it includes some cement companies, etc. So it's a combination of a lot of businesses on the short side, particularly those which will get impacted by inflation, lower consumer demand, and yet valuations are expensive.
Okay, you mentioned autos. Just a follow-up. We've seen a big rally in auto stocks this year. Stocks have rallied 30 to 40% from the recent lows. Any rethink here? Because a lot of it is purely driven by supply. Maybe we still haven't seen the demand numbers pick up, and the stocks have already rallied.
That would definitely be true for certain segments of auto, and probably for the shorter term, even auto would be a little overdone. But having said that, there are segments of auto which are exhibiting strength. Let us say some parts of the SUV segment and probably commercial vehicles, where probably in case activity picks up, there is still some upside. But I am with you that probably for the shorter term, a lot of the upside is already captured.
When you said sectors getting disrupted, Rajesh, and we talk about telecom, I noticed you said hopefully not. So